What's up guys, welcome back to DCA. Today what we're going to do is talk about the Dca Index Model. I'm going to show you how this can be used as a risk management tool. Specifically, I'm going to show you how I use this in order to inform my decision-making process during the market cycle. So if you guys like this type of content, hit like and subscribe. And if you would like the trading view indicators that I've coded for Bitcoin, Ethereum, Solana, Cardano, and Matic, head over to the Telegram channel. There's a form there to sign up and I'll send it to you within the next day or two. Okay, with that said guys, let's jump on in. Okay guys, so this is the Dc8 Index Model. Basically, what this model says is if you're above 50, you will begin to sell or DCA out of the market. And in general, if you're below 50, you will DCA your way into the market. Now, one way you could do this is by doing a static fixed amount. In other words, if you are at a new band, a new index band, you would sell 20%. And then when you got to the next, you would sell 20% more. And then you would sell 20% more, and so on and so forth. And you would continue to do this all the way up to the highest index band. Conversely, on the way down, regardless of where you're at, as long as you're below 50, you would just buy whatever your weekly or monthly DCA amount is, or whatever time frame you personally DCA. If you would have been using this model, where would you have accumulated Bitcoin at? And at the start, right after the 2017, 2018 bull market, you would have started accumulating right at the end of January. So you would have accumulated Bitcoin from a bottom range of around 3,000 all the way up to 12,000. You would have kept accumulating, except in these time frames when you may have even considered selling some. You could have sold up to 40% here, and then you would have resumed accumulating. And so essentially you would have accumulated between $3,000 and $15,000. Okay. If you average out what your accumulation would have been, it would be about $8,000 would be your cost basis. Then you would have started selling at each new index tier. So 20%. And then once you got to the 60 to 70 range, you would have sold 20%, etc. up to here. And then you would have sold your final 20% here at around $60,000. So at worst, you would have been 2x over this time at your least profitable sell, which is here, right at around $16,000, $17,000, $18,000. You would have been 2x from your cost basis. And at best, you would have been around 7.5x up here at $60,000, where you sold your last 20% here. Now, this is one way to approach the market with doing a fixed buy and sell schedule, but you're really selling a larger percent at these lower ranges than maybe you would want to, and you're not buying as much as maybe you would want to at the lower DCA index levels. So that's, kind of the whole point of a model like this is it can help you identify, specifically it can help you identify where the peak is or where the peak may be, but it can especially help you know when are the best times to be buying also. So, it really has utility in both of those scenarios. So let's take a look at another example here. This would be a strategy where you're maybe a little more risk averse on the buying side, but then maybe you want to be slightly more aggressive on the selling side. And these strategies, these can be mixed and matched. You don't have to follow any one strategy that I show you. There's different ways you can approach this. If you want to buy maybe higher up into this range, you could also do that, and you would just adjust these values. What this says is when you're below 40, you'll buy whatever your DCA level is. Then when you go from 30 down to 20, now you're going to buy 2 times whatever that value is, and so on and so forth. So when you get down from 20 down to 10, you're going to buy 3 times whatever this level is, and then 4 times down here. And just note, these these levels, this 10 to 0, this does not come very often. It's very rare. In fact, we've only been down in this level 2 times. So we got here at the beginning of 2015 at the market cycle bottom, and in December of 2018 also at the market cycle bottom. So it's very rare to get down to these levels. And so when you do, if you get the opportunity, it's best to take it and buy as much as you can. So let's take a look at this strategy in general then. So here, now you would have been accumulating from a range of 3,000 up to 10,000. Okay? Remember, here you were accumulating up in these areas also up to $12,000. So remember, this is a slightly more risk-averse strategy. So when you're in the 40 to 50 range, you just decide to do nothing. Now you could also do this where when you're in the 30 to 40 range, you do nothing. But I think when you're doing that, you're sort of limiting yourself in when you can buy, because down anywhere below 30 doesn't come along very often. Okay guys, so now let's take a look at how you would get out of the market. So instead of using the fixed DCA strategy that you were using here to sell 20% each level, you would use a dynamic selling strategy. In other words, you would sell X, 2X, and 3X at each one of these levels. Okay, so how you would do that, if you wanted to find the specific value, you would add up 3 plus 2 plus 1, and so 6X equals 100, 100 divided by 6, and you would come to that value and then multiply it by X. Okay, so, and that would give you the percentage you would sell at each level. Now, the advantage of a strategy, so you have to examine the advantage and the disadvantage of each. The advantage is you will obviously be selling a higher percentage at a higher price. The disadvantage, however, is that you never can be certain that you will make it to the next DCA index level. Okay? So it's a risk-reward strategy. If you think that the market still has a ways to go, then a dynamic strategy is often the best. Something like this, and that's the risk you take, that it doesn't go up. And if you're a person who is short-term focused, then something like this can be risky using a dynamic strategy. Personally, I have a long-term focus on the markets. So if that happens, I'm quite all right with it. I'm prepared at any given point in time to hold, even if it's years more until the next bull market, I'm prepared to hold. So you have to decide what type of investor you are and how you will adjust your strategy accordingly. This just shows the various levels where you would have bought given this strategy. And since it's a risk-averse buying strategy, but a slightly more aggressive selling strategy, you would have had a lower cost basis than you would have at other levels, but you would have sold at an average higher price because you would have sold 3X up at 60,000. Whereas in this case, you would have sold, if we start here, 20, 40, 60, 80%. You would have sold 80% of your Bitcoin by 40,000. And then you would have sold the remaining 20% up at around 60,000. So that's the risk and the reward. So here you're selling the majority right at around 60,000. Whereas here you sold the majority between the ranges of 20 to 40,000. Because of the fact that I personally have a longer term focus on the market, I'm quite all right with holding X amount of Bitcoin, even if it takes years to get back to, the higher risk levels. Typically the price trends upwards. So if I have to hold a certain amount, if it doesn't get to the 90 to 100 level, then that's all right with me. So this is my personal strategy. And, for the rest of the video, I'm going to be talking specifically about how I use my strategy to shift between Bitcoin and altcoins in various situations. Okay, so what I do is I actually will buy up until a level of 60, but I decrease the level of which I'm buying. So in other words, transferring fiat into Bitcoin between the risk levels of 50 and 60. Okay, so I only do a 0.5 here. Now from 50 to 40, 40 to 30, etc., I increase my buys. So as we're in these portions of the market, I'm buying more and more all the way down. Okay. And if we're so lucky to get down to this level, most people, remember, it is psychologically extraordinarily difficult to be buying down here because there's nothing but bad news in the market. There's nothing but FUD. There's nothing but people telling you you're making a bad decision. Yet this is the point in time where it tends to be the best time to buy, because when you're buying down here, your profit margins are absolutely massive. If you bought during the COVID capitulation event, your profit margin was absolutely massive. Okay, and you'll notice that the Dca Index risk model points these locations out and tells you that this is when you should be buying. That's my general approach. Then I use a DCA dynamic, a dynamic DCA exit strategy as well. So I do X, 2X, 3X, and 4X. I'm willing to hold approximately 40% of my Bitcoin until the highest risk level. So I sell X, 2X, and 3X by the time we got to January, and then I sold 40% of it at around $60,000. Okay. Another slight variation of this you can use, and this is personally what I do, I'll wait to see if it gets to 70. And if it does get to 70, then I don't need to have sold that portion that I was going to sell down at these lower levels. And then I can set a stop loss at the bottom of the 60 level in order to make sure that I lock in whatever that profit was going to be. Okay. And then if I don't need to do that, then, well, now I brought this portion of it with me into the 70 risk band, and I can set the stop loss at the bottom of the 70 band. I hope I'm making that clear, because I know that point is a little confusing. I actually even considered not bringing that up, but I think it's an important point, and it can actually vastly increase your profit margins. Because suppose here you just sold X and then 2X and then 3X once you got up here. Instead of doing that, you could have held X and 2X all the way up until this level and set your new stop loss right here, or your stop limit order anyway. You could have set it right here and then locked in all these profits right at around $33,000 instead of having sold them all in these ranges down here. So instead of making your first sell down here at about 20,000, you could have sold it at 33,000, okay, or higher. So I was hoping that it gets up into this area during this time, but it didn't. But I had a stop limit order here, so I was able to sell everything that I was going to sell from the 60 to 70 and the 70 to 80 level. I sold it all at the 80 level. So that's a key point. Another key point. So I get a lot of questions about this. What happens to that money after I sell it? Does it go all into fiat? Does it go into stable coins? When do you buy altcoins? I guess this in general is what I do. And this part of the strategy is not necessarily fixed. I'll vary slightly what I'm doing depending on the situation. But in general, during the bear market, I'm accumulating Bitcoin and Ethereum and then altcoins in a ratio of approximately 60 to 20 to 20, or 60 to 25 to 15 might be actually closer to what I'm doing. So 65% Bitcoin, 25% Ethereum, 15% altcoins during the bear market. And I will I will do that based on whatever I think are the most quality projects, and I will use, you know, the altcoin index models in order to sort of roughly gauge where they're at. The reason for that is for that ratio, because Bitcoin typically leads the market cycle, right? It's moving up, and we've done videos on this before. It is moving up while other coins are remaining stagnant, okay? You know, we have an entire video you guys could go watch. I will actually link that video above as well. It shows how during the start of a bull run, when Bitcoin gets above its 20-week moving average, it moves first before the altcoins move. It leads the charge. So once it starts to get up into these levels, that's when I begin to sell. And the reason that is because I move some of my Bitcoin profits into altcoins. During this time, when you start selling the Bitcoin, I start to move those profits, at least a percentage of them, into the altcoins, primarily Ethereum. That's the type of investor I am. I'm investing in Bitcoin and Ethereum, and then a smaller percent in altcoins. Now, once we're in the setting of the bear market, now remember I was doing about 25% Ethereum, 15% altcoins during the bear market. But in the bull market, what I do is something closer to 60-40 or 50-50 or 70-30, depending on the situation. Okay, so I'm selling some of my Bitcoin during the bull market and moving it into the altcoins. Once Bitcoin is above this level, remember, I'm not acquiring anymore. I'm acquiring no more Bitcoin. Okay, so let's just go over an example, guys. So remember that, I said that when Bitcoin gets into these ranges, I'll start to sell. But recall, I will hang on to it if it doesn't reach these tiers, right? So it gets up to 70 and it just goes straight through. So I never sell because I held it and I held it, and I didn't really start selling it until about here on the 10th of January. So, because remember, I sold when it hit this limit order at around the 80 level because I held it because it never came back down. So I never hit my stop limit order. So I sold X, 2X, and 3X all at around this level and started moving them into altcoins. So if we come here then, so this is if we go to around January 10th, so this is Ethereum now we're looking at. Okay, well, Ethereum was in this 70, it was in this 70 range. So, this is kind of the point where, some finesse comes into play and you kind of have to use your own discretion. Typically, I will never put fiat in above 60. So when Ethereum, now remember, we're in the setting of a bull market here. So I do expect Ethereum will go higher, but we're sitting at around the 80 level right here. So I don't put any in at this time. So I'm sitting in stable coins. And then as soon as Ethereum comes down shortly later, down to this right here, it came down 2 days later, down to about $1,000. That's when I start moving into Ethereum. Okay. And again, we come down and then, there's all these opportunities and I move in when we're in these lower ranges, usually up to 70. So I won't go in anything in this 70 to 80 range. Okay. So we come down and I'm acquiring during this time because remember, Bitcoin's still above its 20-week moving average. We're back in the bull run. So I'm acquiring. And then once we start moving up, as soon as we get above the 70 level, I start to sell some. And then once it's above 80, I sell a significant portion. And I don't have a set X amount for the altcoins like I do for Bitcoin. And remember, this is because the Bitcoin model is much, much, much stronger than the altcoin models because there's more data. More data is a stronger model. With the altcoin models, we don't have that quantity of data, so we cannot say with as much certainty that we trust the value of where we're at. So this just becomes a more general indicator. Okay? It becomes a general indicator of when you may be reaching the top. So once we're in this 80 range, I didn't sell all of my Ethereum, but I've probably sold around 60% or so, 60 or 70%. So once we get up to here into the mid 2000s, then I'm getting out. I'm getting out of the market. So probably the last point which I've acquired is right around here, around 2100, and then once we're up in the low 3000s, we're getting into the 80 range, I'm getting out of the market. Okay? Especially, and I can't stress this enough, when Bitcoin went below its 20-week moving average right here, I am exceptionally prone to selling my altcoins for the reason that if we bring up a new chart, let's look at Cardano here. Okay. So, this is Cardano back in 2017. Now, recall Cardano actually held up quite well during this market cycle drop. But back in 2017, after the bull market ended, okay, and this is why you have to be so careful with altcoins. I cannot stress this enough, and I don't think enough people appreciate this fact or give it the gravity that it deserves. So if we go, let's say you FOMO'd in at the end. If you held Cardano at one point, several months later, you were down 97%. And even further than that, you were down 98.5%. Okay. So if you put $1,000 in, you had $15 left at one point. Consider that. It's just a psychological beating to be down 98.5%. And that's not to say that will happen again with Cardano, but it is to say the altcoins, the volatility on the altcoins can be absolutely massive, especially in the setting of a bear market. So when Bitcoin gets below that 20-week moving average, I decrease my threshold for selling. Okay, so that's typically how I'm approaching this. Okay, guys, so that is my general strategy. I'm DCAing into the market at approximately these ratios during the bear market. Even right now, I'm DCAing in, but a smaller amount, right? Because once the market has time to adapt and your price becomes your new paradigm, then, once there's a paradigm shift in the market, then that risk level, which may have been a certain price in the past, this price in the past would have been up here. But since we've had time to adapt, the risk value trends down, and you can accumulate, or I personally do. If you want to take a standard strategy, you would just either be selling a small amount here or doing nothing. So I'm accumulating a small amount, and as we go up, as we get into the X, 2X, etc., I will start to move more of that into the altcoins. Okay, and remember, during the bull run, I will be doing something between 50-50 up to 70-30 Ethereum to other altcoins. Now with the altcoins, I'm selling those as they go into the higher risk tiers. So this is Solana. So I sold a lot right here at 16. Okay. And then just kind of I was out of Solana actually at 16. And then once it got below, so here at the end of May, then I started accumulating again, and I accumulated a ton of Solana during this time. Okay. So all the way from, if we just blow this up here, So from, you can literally just go from the date from there. Okay, so during this time, I was accumulating Solana anywhere from 19 up to $60. And then once we got up to, once we got into the, 180, 170, 180, I was out of, I'm out of Solana again. And now here we are again. I've accumulated a small amount. Now I do try to, apply, like I said, I try and apply a certain level of fluidity to this strategy. So at this $200 level, I'm not quite accumulating as much Solana as I did in the past. And that's for the fact that, I do think Solana is a great project. And in fact, I could see Solana going much, much higher from here. But, we've been up to this level twice already. And a lot of times, it can definitely go higher. But a lot of times once you've reached this extreme parabolic level twice, it can be tough to get there a third time. And in fact, we did almost get there a third time. So if Solana goes down and starts getting into the, 50 to 40 range, then I'll start acquiring heavily again. I have started acquiring a small position again, but it's just a small position. I'm mostly out at around 180, 190 range. Okay. And then you can just kind of go down the line. So Matic, same thing. We got up close to this level twice. And, then we did get up here at, in the middle of May, right before the market cycle drop, and then just acquiring a ton. And I mean, when we got down to like the 60s and 70s, I just bought a bunch of Matic. And now it's just kind of, we're just in this accumulation zone. It's just trending sideways. So we're just sitting back and waiting, because I think Matic is another, Polygon is another great project. So I anticipate this trending much higher. Okay. So that's kind of how I'm approaching it, guys. I know there's a lot to this topic, but if you guys have any questions, feel free to message me. I try and respond to everyone on the Telegram channel. So if you have any questions on there, feel free to message me. If you would like these TradingView indicators, you can sign up on the Telegram channel and I'll send them to you guys. And with that said, I think that's it for this one. So if you guys like the content, hit like and subscribe. And until next time, as usual, see ya.